Recording sales transactions. Now, we are PW Audio Supply. We're a merchandiser. We sell to Sock Stereo. May 4th. Terms 210, net 30. Free on board shipping. So it's on our dock. And these are the items, and we sold them for $3,800. Now let's assume we paid $1,700 for these items. So now we have to record the sales transaction. Well, when a merchandise company on a perpetual inventory system records a sale, it must record two separate journal entries. One, record the sale, and two, record the expense and reduce the inventory. So in this case, we purchased on term, or we sold on terms, so they're going to owe us. So it's debit accounts receivable, and it was $3,800. And we credit sales or sales revenue, and that is a credit of $3,800. Now the goods have left the building, so we must recognize that our inventory has been reduced and that those goods that we sold for $3,800 cost us $1,700. So the next journal entry then is debit cost of goods sold, and that would be for $1,700. What I paid for those items that I sold for $3,800, and credit inventory. So we have two journal entries when we make a sale. Now what happens when they return the items that we sold them? Well, keep in mind when we sold it to them, we credited an account called sales. Now when they return it, we could reduce that account. But if we want to keep track of anything in accounting, we set up a separate account. And we head it up, sales, and we're going to call this returns and allowances. And this is not an asset account, or it's not an expense account. It's a debit balance account, but it's what's called a contra account. That means it has a balance opposite. In this case, it's a contra revenue account. Therefore, it has a debit balance because revenue has a credit balance. So therefore, assume the goods were returned to us that we sold them for $300 and they cost us $140. Well, we debit sales returns and allowances for $300. We reduce the amount they owe us. We skip a line now and we record the fact that we returning the inventory onto our shelves, and we reduce the cost of goods sold. Now, recall that we sold the items to them for $210 net 30. $210 and 30, which means a 2% discount if they pay within 10 days. And so it's May 14th, which is 10 days. Now they originally purchased $3,800. They returned $3,000, so they owe us $3,500. So when they pay us now, they are going to reduce their accounts receivable. So I credit accounts receivable. I recognize the amount of money they give me. Now they're not paying me the $3,500. They are going to take a 2% discount. They're paying me $3,430. And that discount we put into another contra revenue account called sales discounts. And that goes over here. And that's how I record the receiving of money on a discounted basis from a customer. So to visualize that in terms of T account, this is our revenue account. Now we've set up one and two, what are called contra revenue accounts. Okay, and all they are is set up to have a balance opposite that. That means we're going to subtract sales returns allowance from sales revenue and sales discounts from sales revenue. Now let's go through an example. Here we have the following entries for Cleary Company, which uses a perpetual inventory system. On March 2nd, all right, March 2nd, Cleary sold $800,000 to Linda Company, terms $210 net 30. So if it's on terms, then we know that Linda has an account with us and will pay us later. So we recognize first of all the sale on account. So it's debit accounts receivable. I am going to be receiving, hopefully in the future, the 800,000. And I credit sales or sales revenue, 800,000. Now, I have to recognize that the inventory has left and I have a cost of goods sold. So I skip a line here, same date, and I do cost of goods sold. And the cost of goods sold is 540,000. That's what I paid for those items I sold for 800,000. Not bad gross profit. And I take it out of inventory, so I credit inventory 5,400. And that's it. Now on March 6th, Linda returned 140,000 of the merchandise, and the cost to me of that merchandise they returned was 94,000. So therefore, on March 6th, I have to make the entry, again, 2 entries. One, debiting sales returns and allowances, the contra revenue account, and for the full amount of the sale, 140,000. And I reduce the accounts receivable that Linda owes me, and it's credit 140,000. Now I put it back into inventory at its cost. So I debit inventory 94,000, and I credit the cost of goods sold. I reduce the expense because it was returned to me, and I credit that 94,000. And lastly then, the cost of merchandise return was 94. On March 12th, Cleary received the balance due from Linda Company. So let's do it on a T account basis. What we had then was the sales of 800,000 and sales returns and allowances of 140. Therefore, accounts receivable was 800,000 and 140. So the amount that Linda owes me is 660,000. So therefore, in this transaction, March 12th, I'm going to receive cash. She's going to cancel her accounts receivable, Linda Company, or they're going to recover, and that's going to be a credit of 660,000. Now they're going to take a sales discount. So I'm sorry, the sales discount is over here. Debit sales discount, and I take 2% of that, which is 13,200. And they pay me the balance, which is cash of 646,800. Apologize for that little slip up, but I can't redo this whole video just for that. So please forgive me.